Now, of course, before we start the session, just a quick reminder to scan the Q&A. There's a QR code you can scan and pop your questions in, and we hope to address some of them during the panel discussion as well. All right, so we are going to be talking about this next interesting topic, and it is this: alternative financing strategies turn mainstream amid funding winter. Now, of course, to discuss this interesting topic, please join me to welcome our panelists on stage, starting with Paul Ong, partner, Innoven Capital Southeast Asia. And of course, he's joined by Gena Bijaksana, CEO and co-founder Qverse. And joining them is Darryl Ratulangi, Managing Director, OCBC Venture. And of course, the moderator for today is our correspondent in Singapore for DealStreetAsia, Pimfha Chan. All right, Pimfha, over to you.
Hello, everyone. Thank you for joining us today. Welcome to another session of our Indo-PEVC Summit. My name is Pimfha, and I'm DealStreetAsia's Singapore-based PEVC reporter. I'll be your moderator today. So the topic of discussion today is about alternative funding for private companies. But since we have 3 venture debt investors on the stage today, our focus is going to be more about venture lending into startups and SMEs in Indonesia and Southeast Asia. So I want to thank everyone for joining me today. Why don't we start with a brief introduction?
Hi, everyone. So I'm Paul. I manage Innoven's Southeast Asia business. Innoven Capital is a joint venture between Ventura Group as well as UB Bank. And we're a, I guess, subset of private credit in that we specialize in direct lending to high-growth tech companies across Asia.
So hi everyone, I'm Gena from Qverse. I'm founders and CEO of Qverse. Qverse is a private credit, or we can call it a private debt company. And we support by AI to selecting our clients. So Indonesian is our focus right now, and hopefully we can see through for this discussion. Thank you.
Hi everyone, thank you for having me today. I'm Darryl from OCBC Ventura. So we're the venture capital arm of OCBC Group from Singapore. So we do equity and debt, specializing in Indonesia consumer market.
Before we go into the topic of discussion today, I feel like this morning we've talked so much about the fundraising scene from the view of equity investors, venture capital investors. Since we have private debt investors on the stage today, just wanted to ask, what's your assessment of the latest fundraising scene in Southeast Asia, perhaps in the past 12 months? Anyone can go first.
I think it's definitely improved in the last 12 months. So I think now, as of right now, we're slightly more than 2 years into the funding winter. So, you know, that's been significant gestation period for a lot of companies to pivot their focus towards what investors are looking for. And I think now there's better clarity on essentially which business models work, which don't, where there are clear paths to profitability, if not already profitable companies, versus those that are still struggling. So I do think with that additional clarity, I'm quietly optimistic that equity guys will start to deploy more, in 2025.
What about you, Gena? You also lend to SMEs as well.
Yeah, I think the best word that described our condition right now in Indonesia, especially in Southeast Asia, of course, is there's a shifting paradigm, which is good for me and for all the economic for the Indonesian as a countries. And the shifting goes to be from what Paul said before, that previously still doesn't clear which play game should be works and can be done for everyone's sakes. But right now, it is more clear, shifting to become which pillars that we need to focus. And of course, we have same KPIs. Investor and the founders, the startup have same KPIs. It's not only growth, but also the fundamentals, but also the, we call it responsible growth.
What about you, Darryl? How's the dialogue that you've been having with the founders over here?
Sure. I think the equity market has always been challenging, right? I don't see it changing in 2025. But then the way we see it, there's more and more debt players, and we see ourselves as a complement towards the equity player, right? So I don't agree if we say we're the alternative to an equity player, because then we can't stand by ourselves. And a majority of the debt players requires an equity players to come in either together or after the fact that, after the debt, right? Eventually we have to get out, we have to be repaid, while an equity investor have longer time frames. So the way we see it now is a new market dynamic where the equity and the debt players can work together. And I guess it's a good thing, right? I mean, probably Paul used to be the only guy around running around the market. Now you see more people, and even you guys are covering this as a topic. So we do see it's growing market, and I think it will remain there. Hopefully I'm right.
What about the demand from the borrower side? Do you see more founders and startups looking for more venture debt?
Yeah, so you know, at Innoven, we did a study or a survey across maybe about 200 founders around the region, and we found that you know, interest in raising debt, either venture or growth, has doubled in the last 12 months, 12 to 24 months. So the demand is definitely there. Where we have observed the demand sort of coming from is not from companies that can't control their burn. It's really coming from companies who have identified that path to profitability or is already there, but they're challenged by the equity markets with regards to valuation. So the mismatch in valuation makes it essentially not the right time for them to go out and price, and therefore, you know, turning to borrowing at this point in time makes a lot more sense.
What about Darryl and Gena here? Are you seeing the same thing?
Yeah, I think quantitatively, since 2021, we built this company. Thousands of company goes through our board approval, and of course, this is a very good sign, since if you talk about that, it is quite different from equity, right? If equity, of course, we have good narration, good ideas, good opportunity to growth. But if we talk about debt, since day one, they meet with us in Qverse. We talk to them that our philosophy of our debt is a growth fund. So this is not only a debt that can only use for a bridging for to survive, but you need to have a sustainability part of profitable, and you need to know where to spend the money to boost your growth more better and build your fundamentals better after get fund from us. So I think yes, of course, there's a lot of opportunities and a lot of demand in the market, but also what we need to be grateful for it is I think the standard now is getting better. It's not only about top line, about growth, but also the fundamentals and the, yeah, we call it responsible growth.
So these startups that are looking for venture debt funding, are they coming from a particular sector? Do you see any common thread there?
So I think it's a mixture, right? So I guess different startups look at us differently, right? Some look at us for bridging, some look at us for growth capital. I think in general, there's a lot of misconception as well about venture debt in the market, right? Honestly, when startups comes to us with a 3 or 6 months runway, that, look, I need an extra bridging before my next round. Look, there's nothing any of us probably can do, right? it's too late. If your own investor in your own cap table won't save you, why would us as a new strangers, that player will help you, right? But look, if you're able to raise 8 million and then look, you need another few millions to go faster and to expand more to another region or to go even faster, then we might be the right product, right? Because then we're not as cheap as bank loan, because then we call ourselves venture debt, right? We still we require a certain amount of return. We might be slightly cheaper than an equity guy depending on how you use it. But that's why I would always say we're not a replacement of the equity guy. We're a complement, and we work together side by side.
I want to pivot the conversation a little bit, since I think some of you or all of you are looking at startups or SMEs that are nearing profitability or already profitable. There's not a lot of startups and companies that are profitable these days, or you can correct me if I'm wrong. Does the current financial performance of these companies change the metrics or what you look for in startups these days?
So actually, I think we've started to see a lot more profitability or those clearer paths in the last 12 months, right? I think the 2-year funding winter has really allowed us that time frame to be able to sort of see that. But that being said, I think fundamentally how we assess credit, those metrics have not changed. I think what we hold or what we have a premium on right now outside of profit and positive cash flow is really around, it's less the company and more around the way we structure our loans that has tweaked or has been tweaked a little bit to fit where the market's currently at. But generally, I think we see a lot more companies moving in the right direction.
Yeah, I agree, because actually the KPI is still same, but what we do now in the private debt sector is we promote which one is what we prefer to do better for both sake of the borrowers and for us as lenders. So what we do in Qverse, we promote 3 P's as a pillars. The first is profitability, the second one is prudence, so the financials should be recorded well, and the third one is promising for fundamentals, good fundamentals. So these 3 P's must be not like as a or choice, but this is must be done full if we want to do the business with us. So of course this is a lot of more to do, because since last decades maybe very little bit parties that promote this fundamentals approach, right? But still can be done, and I think it's a move to good towards a good direction.
Yeah, I mean, I think for us, not much has changed, right? So, I mean, if people ask us, what do we look for the founders, right? So we look for character and capacity. In the end of the day, debt players have limited upside, right? It's not like equity guys, look, I can make 10x, I can make 100x. In the end, we can only charge a certain rate, and then we make that rate. And so it's all about limiting our downside, right? Where I think when Paul mentioned, it's all about structuring. So for our debt players, we're trying to limit our downside and make sure we do get repaid. Because even if the company do 100x, we only get a certain amount of rates. And that's it. So we cannot take unlimited risks. It's very different because we also an equity player. When we do take an equity position, we take a lot more risk, because then we do get a lot more reward. And that's why hence the risk.
I wanted to go back to what Paul mentioned. You were mentioning improved earnings in some companies. On a more irrelevant question, what contributed to the improved earnings in the past months?
Well, I mean, it differs for different companies, but it's quite clear that there was a lot of fat in a lot of these companies with regards to the OPEX. Marketing spends were high. I think payrolls were very bloated. So, a bunch of those things, but it's highly business model dependent, right? I think some of them have managed to improve their margins significantly, which has also sort of helped get them to where they are today. So most of them is a combination of increase in margins plus reduction in some OPEX.
Let's talk about some of your recent deals. Both Darryl and Gena here. It seems like some of the recent deals that you've done are in the consumer sector. Tell me what's attractive about that sector.
Okay, we done so. Actually, in first year, we were focusing fashion retails, but
Fashion retail.
fashion retails. And,
Like what kind of companies are they?
modest fashion or apparels, shoes. So, but lately we see the most interesting part is in still fashion, also of course apparels, and the second one is beauty. Beauty is very good right now. Beauty is very good, and the third one I think F&B still very evergreen growth. So what the interesting part that you said before is. In last year, we deal with very good brands in F&Bs, and what they done is to build story about sustainability becomes real, because previously, personally, I said that to him, to the founders, board of founders, that for the first time I see the profitability and the sustainability can work together. So this is very good sign for everyone that bring up the story about sustainability and finding a way to be more profitable and still growing with the good rates. I think this is still very good. I think this is good, yeah, for everyone.
What about you?
So I mean, we like the consumer sector. One of the reasons, I mean, their margin is high, so they have enough capacity to pay us, right? So that's very important for us. And they always need capex, which then they need more and more money. That's where people like us come in. And the other one, we like it's a good probability for us to exit our position as well. We see that a lot of the VC are shifting into getting more and more into consumer brand, consumer product. And this is a space that the PEs, at least in Southeast Asia, this is the thing that they like. And the more visibility we have to exit, the better that we are able being refinanced. We made money on our warrants. So it's just no-brainer for us. It's a target consumer for us.
What about you, Paul? You seem to be very bullish for SaaS companies and e-commerce companies recently. Tell us about it.
Yeah, so, actually very in line with what Darryl just mentioned. So we look at e-commerce more as a method of delivery, right? I think at the end of the day, we're still investing in consumer companies. So we're still very bullish on consumer companies for all the reasons that both Darryl and Gena mentioned. For great margins, as well as, I guess there's a lot less we don't know about those business models in terms of when we assess business model risk. Outside of that, yeah, SaaS is always a go-to for us. If we find good SaaS companies in the region, mainly for the recurring revenue that they sort of generate. So same for fintech. Yeah.
So Paul, you cover the whole SEA region, right? How does Indo stand out for you?
It's still the largest market with the most promise. I'm sure everyone's said that many times over the last 10 years. But generally speaking, I think when we look at the region, it's really where the capital needs to flow, and it's really where there's still the highest probability of building the largest companies within the region.
So Gena, will we be seeing you doing deals in anywhere outside of Indonesia?
Yes, we love to do that, of course. But what we need to prepare, of course, the fundamentals of understanding about the risk, right? Because every country have a different risk appetite, risk profile, of course, and also the regulation.
Is there any recent change in regulations that we should know about?
I think every country have preferences about do and don'ts, right? So I speak with Darryl previously that we talk with Indonesian FSA, OJKs, and of course OJK is in Singapore and FSA is different approach. So I think the best thing that we can do for now, since we promote also the sustainability path, we also promote our understanding of our path to grow itself as also the constant and sustainable, and I think careful to to develop new market. But also, actually, since last 2 years, we already seek Malaysian and Singapore and Thailand company for to discuss as early discussion. But yeah, we need to understand more first about the risk profile and the country's regulation, I think.
What about you, Darryl?
So for us, no. We focus mostly on Indonesia for a simple reason. Our competitive advantage is here, right? So for us as a debt player, one of the key is character. And to understand people's character is how you build your network. Who I can ask, who can vouch for the guy or who can vouch for the girls. That matters a lot for us. It's the who. And I can only know the who is by network embedded in here, right? Why I can do it better than other investors is because we sit on the ground. A lot of us are Indonesian in the team, and we do have that network to vouch. If we go to Vietnam or if we go to Malaysia, Singapore, it's not that the market's not big. We just lose our competitive advantage, and we'll become like every other investment manager out there. And I don't think we can deliver the returns that we are delivering in Indonesia.
Yeah, that makes sense. So we've talked about the consumer sector, we talked about SaaS companies. Is there any up-and-coming sectors in the markets that you're looking at? Any interesting sectors emerging?
Well, I still would like to see more capital go into, climate development, or the development of climate solutions. Outside of that, I think fintech is still. I think there's still a lot of opportunity in financial technology.
Yeah, for me, still those three that I mentioned before still prefer for us, but also actually if we look about the statistic of the separation that banks support right now, actually the biggest sectors that supported by the banks is manufacture and B2B services. So this still very large opportunity there. So we are starting to move to study the risk profile, and of course we also developing our new products that can cover their needs and
Sorry, what's
demands.
the new product again?
We still
Is it
not
a
disclose
secret?
it, but we learn to we eager to learn what our predecessors like peer-to-peer lendings does previously and improve those products to become more prudent and preferable for everyone, not only for the clients but also for the regulators and also for us as a businessman.
I mean, for 2025, ours are probably quite boring, right? So we like beauty and wellness for a very simple reason. I mean, people use them, look, our income's growing in Indonesia, and everyone's talk about Gen Z with the social media. Look, everyone needs to look good. Everyone cares more about their health after COVID. So for us, that's a very simple thesis. So we just finance that. Look, if people stop using it in 2026, we might change, but we don't see that anytime soon. So that's our very simple thesis on Indonesia.
I wanted to go to one sector, which is lending companies. These lending startups, whether BNPL or P2P lenders, they always have to go to like either private credit investors or the banks to get financing all the time. How are they performing amidst the current macro conditions?
So there was a period of time where I think there were, how many? 120 OJK registered P2P lenders in Indonesia. I think we've come a long way since. And I think, the platforms that are left are generally doing pretty okay. I think from, obviously you hear stories of bad credit and NPLs, but a lot of that, every lender will have NPLs. It's whether or not that has been factored into the assumptions of the book, right? And I think, generally the sector has been playing out, as it should.
Anyone wants to add to that?
Everyone have heard the horror stories of the P2P or the multi-finance business in Indonesia, right? But to say that represents whole Indonesia is not true. there are still a lot of good lenders out there, good borrowers out there that just needs more leverage, right? A lot of them are probably underbanked, right? Because banking in Indonesia requires significant collateral value, which then leaves room for all these P2P players to fill in, because then they don't have enough collaterals and they do need the leverage. But not all of them are good, right? When there was like 100 millions or billion of dollars flowing into Indonesia, like it makes the founder to take more risks. And that is exactly what happened, right? NPL happens because then banks or financial institutions take bigger risks than what they are capable of, and they are taking that to get more and more rewards. But now when fundings are a bit more difficult, now we put the brake on. Look, we care about more of our risk management. I mean, when the business team runs the risk, look, everything's gonna be a yes, right? It's a no-brainer. If you ask any business guy that says no, might as well put them on the risk team, right? Yeah.
What about you, Gena? What would be your piece of advice to a founder looking for money from you?
Yeah, I think, of course, we need to know first about, I agree from Darryl, it's about character, yeah. Because character represents everything. Character represent the idea of how they build the business and how they build the growth. And of course, it will be represented how they doing the business. So actually, they need to become more sincere with which one they need to seek the growth path, whether it's only the valuation or long journey to run the business and give good deeds for everyone. So this is the first, and the second one, of course, we need to promote prudentiality of the financial tracking. We need to look more deeper about how we spend our costs, and actually, if we already put others investor monies in our bank account, and always being cautious. Actually, this is not our money. This is investor money. So we need to be more wise, I think. This is the fundamentals. And after that, of course, they need to become more strategies to seek whether this path can be more profitable or this is more growth or etc.
Oh, do you want to add to that?
I mean, we're lenders, so we technically should be less picky than equity guys. But you know, the one piece of advice is, you know, just tell us how we're going to get repaid, right?
That's very good.
I think I echo that, right? It's simple for us, the players. Look, how I'm getting repaid, look, and it's the quality of the earning, right? How are you going to beat your competitors? And look, what you make today is what you're going to make next year, and that's enough to able to repay us. We don't need that 100% or 200% growth because we just need to get repaid.
I wanted to shift to a bigger picture question since we're running out of time here. I want to go to Paul. Paul, you've been with Innoven for quite some time and you helped them set up the SCA business as well. What's the evolution of the venture debt scene in Southeast Asia that you've been seeing?
Yeah, so we started in Southeast Asia in 2016, and at that point in time, I think there was essentially no such concept of, you know, lending to early stage tech, and you know, through educating the market, I think we've grown it not just on the knowledge side, but as well as the utilization side, and I think any mature tech ecosystem would require a good set of lenders to be part of it. And I think as the years have progressed, I think we've seen more entrants, which I think is beneficial for you know, companies as well as ourselves, right? 5 years ago, there was no panel for me to be on, so this is great to be able to sit down with some other like-minded investors. Yeah.
That's great. I think we've come to the end of our session. We have some Q&As from our audience. The first question, how is the performance of your debt financing? Is there any NPL or NPC?
Yes, of course. Of course, this is the real business. Of course, there is profit and also the risk. But since we do very carefully, yeah, for us, we can maintain still 1% NPLs in last years. So we try the best. But of course, this is a choice, right? We do that by carefully picking with which one we need to work for. And of course, it need to be mutual understanding about the board, from the boards and from the investor side about the expectation of the growth. So this is same like other startups, I think.
Thank you. So one last question for everyone. Outlook for this year. What do you think about the fundraising scene?
Okay, maybe I'll start. I mean, it's only the start of the year. We are very thankful. We're busy. I think we're looking at more and more debt deals. I hope that it's happening towards the equity side as well. But if not, I think we'll also be a happy camper because then we're seeing a lot of debt deals.
Same.
Yeah, no, likewise. I think first half of the year will be a continuation of last year, but then I hope that more capital starts to flow back into Southeast Asian alternatives. Yeah.
Well, thank you everyone for joining today.
Thank you.
Thank you.
Thank you.
Thank you so much to our panelists. And of course, we'd like to invite our panelists to step in front of the tables. Yep, yes, closer to the edge of the stage. And the camera that you should look at is the one right in the center. Right over here. That's right. Give a big smile to the camera. Now, ladies and gentlemen, coming up, we're going to be having a quick caffeine break. Time to come back would be 4:30 p.m. Just a quick note. To avail your attendee exclusive summit tickets and bundles for next year by scanning the promotional banners or approaching with DealStreetAsia information desk. So the break will be till 4:30 p.m., about 30 minutes. We'll see you back in your seats at 4:30. Don't forget as well, today we have our cocktail networking. That'll be happening in the evening at about 6:30 p.m. rather. 6:30 p.m. we'll be having our cocktail reception. So make sure you stay on for that all the way till 6:30 as well for the cocktails and the networking. Some quick announcements. We have some wonderful sponsors to thank.